Good morning, everyone. I'm very pleased to be here with the Senior Deputy Governor, Carolyn Rogers, to discuss the Monetary Policy Report and today's decision. Governing Council maintained the policy interest rate at 2.25%. We've held the policy rate at this level since last October. We have three key messages today. First, Canada is being buffeted by global events and geopolitical uncertainties, but our economy is growing, and we expect it to continue to grow. Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices, combined with still elevated food price inflation, is squeezing more Canadians. And third, monetary policy is focused on ensuring that the jump in energy prices does not turn into persistent inflation, while helping the economy adjust to global headwinds. We are committed to keeping inflation low and stable over time. On a trois messages clés. Premièrement, même si le Canada est secoué par des événements internationaux et des incertitudes géopolitiques, notre économie croît et devrait continuer de progresser. Deuxièmement, les prix mondiaux plus élevés de l'énergie font monter l'inflation qui était restée près de la cible de 2% pendant plus d'un an. La flambée des prix de l'essence et les hausses encore élevées des prix des aliments mettent plus de Canadiennes et Canadiens sous pression. Et troisièmement, la politique monétaire a pour but de s'assurer que le bond des prix de l'énergie ne se transforme pas en inflation persistante. Elle vise aussi à aider l'économie à s'ajuster au vent contraire à l'échelle mondiale. On cherche à maintenir l'inflation à un niveau bas et stable au fil du temps. Let me expand on the economic outlook, the risks, and the implications for monetary policy. Since our previous forecast in January, the war in the Middle East has sent global energy prices sharply higher, increased financial market volatility, and disrupted shipping for fertilizer and other commodities. This has lowered the outlook for global growth while boosting inflation. In Canada, growth looks to have resumed after contracting at the end of 2025. Consumer and government spending are contributing to growth, while U.S. tariffs and trade uncertainty are weighing on exports and business investment. The labor market is soft, with the unemployment rate remaining in the 6.5% to 7% range, reflecting both weak hiring and fewer job seekers. Our forecast for GDP growth in Canada has not changed significantly since our January projection. The conflict in the Middle East will affect the composition of growth, but the impact on overall growth is expected to be small because higher global oil prices will increase the value of our energy exports, even as they squeeze consumers and many businesses. In our forecast today, the Bank of Canada projects the economy will expand 1.2% in 2026, 1.6% in 2027, and 1.7% in 2028, as growth in exports and business investment gradually resumes. With GDP growth slightly above potential, the current excess supply in the economy is slowly absorbed. Until the war, we expected inflation to stay close to the 2% target. But sharply higher gasoline prices are now pushing up inflation. CPI inflation rose from 1.8% in February to 2.4% in March. Core inflation has been easing and held steady just above 2% in March. The proportion of the components of the CPI basket rising faster than 3% has also declined in recent months. So far, there is little evidence that higher oil prices have fed through to other goods and services prices more broadly. But it is early days, and we will be watching this closely. We will also be closely monitoring inflation expectations. Near-term inflation expectations have moved up with higher gasoline prices and still elevated food price inflation. But longer-term inflation expectations remain anchored. Based on recent market expectations, oil prices are assumed to decline from an average of about $90 a barrel in the second quarter to about $75 a barrel by the middle of next year. If that happens, inflation should peak around 3% in April and then ease back to the 2% target by early next year. The Bank of Canada is committed to keeping inflation close to the 2% target over time. The monetary policy needed to achieve this will depend importantly on what happens with the Canada-US-Mexico trade agreement, how the conflict in the Middle East evolves, and the impacts of US tariffs and energy prices on our economy. À notre réunion cette semaine, on a décidé de maintenir le taux directeur à 2,25%. Le conseil de direction s'est entendu pour regarder au-delà de l'impact immédiat de la guerre sur l'inflation. Mais si les prix de l'énergie restent élevés, on ne laissera pas leurs effets se transformer en inflation persistante. Selon notre prévision de référence, les prix de pétrole vont diminuer et les droits de douane américains vont rester au niveau actuel. Dans ce cas, il serait approprié de maintenir le taux directeur près du taux actuel pour faciliter l'ajustement de l'économie et ramener l'inflation à la cible. On pourrait devoir ajuster les taux directeurs selon l'évolution des risques. Mais si l'économie évolue de manière généralement conforme à cette prévision, les modifications du taux directeur devraient être modestes. Mais l'incertitude est plus élevée que d'habitude. Il y a beaucoup d'issues possibles. La politique monétaire pourrait devoir être souple. At our meeting this week, we decided to maintain the policy rate at 2.25%. Governing Council agreed to look through the war's immediate impact on inflation, but if energy prices stay high, we will not let their effects become persistent inflation. Our baseline forecast assumes oil prices will come down and U.S. tariffs will remain at current levels. If this holds true, a policy rate close to the current setting looks appropriate to support the adjustment in the economy and return inflation to target. There may still be a need to adjust the policy rate depending on how risks evolve. But if the economy evolves broadly in line with the base case, changes in the policy rate can be expected to be small. However, uncertainty is unusually elevated, and there are many possible outcomes. Monetary policy may need to be nimble. If the United States imposes significant new trade restrictions on Canada, we may need to cut the policy rate further to support economic growth. Alternatively, if oil prices continue to increase, and particularly if they remain elevated, the risk that higher energy prices become ongoing inflation increases. And if this starts to happen, monetary policy will have more work to do. There may be a need for consecutive increases in the policy interest rate. Of course, these are not the only possible outcomes. We'll be watching developments closely and assessing their implications for growth and inflation. As the outlook evolves, we stand ready to respond as needed. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
All right, we'll start with questions here in Ottawa and then go to reporters who are joining us remotely. We kindly ask that you limit yourself to one question so that we can get to every media outlet. Before asking your question, kindly state your name and affiliation. Libre à vous de poser votre question dans la langue officielle de votre choix. So we'll start with Reuters, followed by The Logic, then the Globe and Mail. So go ahead, Pramit.
Thanks, Becca. Good morning, Governor. With inflation in April expected to reach 3%, what is your message to households and businesses who might start demanding higher wages and the broader inflation expectations might also go up?
Well, first of all, we know higher oil prices are hitting Canadians. They're hitting businesses, they're hitting consumers. We've all gone to the gas station and filled up our tank. That's against a background where food price inflation has been running high for a number of months now. These price increases reflect global events. I mean, the best thing that could be to happen would be that these price increases go away at the source, but that's not something we can control. What can we control? What we can control is we can ensure that these price increases in particularly this surge in gasoline prices and other fuel prices, it doesn't become generalized, persistent inflation. Maintaining the policy rate today, where it is, was the right thing to do for today. And as we've indicated, if things evolve broadly in line with the outlook we've presented, and in particular, oil prices come down broadly in line with the futures curve, something close to the policy rate that we have today is probably about right. We might need a small adjustment, but I think it would be reasonable to expect small. But particularly if energy prices go higher, and particularly if they stay higher for longer, there could well be a need to increase the policy rate to get inflation back to 2%. And really the message is, we're committed to ensuring that inflation does stay close to 2% over time.
Go ahead, Kevin.
Good morning, Kevin Carmichael from The Logic. You had a look at how AI might be affecting productivity and updating potential output. Is that yet factoring into policy making here in the present? Maybe just talk a bit about how you're thinking about AI as you sit down to look at rate trajectory.
Well, let me put it in broader context, Kevin. There's a few things affecting potential output, and once a year, as you know, we do a comprehensive review of our assessment of potential output and the outlook for potential going forward. And that is, we do that each year in the April monetary policy report. So there is a pretty detailed appendix on that in the report. Look, there are, I would say, three key things affecting potential in the outlook. Population growth is historically very low. There's basically, in our outlook, there's almost no population growth. So that means that, we're not adding new workers, new consumers, a lot of new workers, new consumers to the economy. So that lowers potential output going forward. The second factor is, and we've talked about this quite extensively in the last report and in some previous speeches, the Canadian economy is going through a structural adjustment. Our trade relationship with the United States is fundamentally changed. Businesses are adjusting to that. And as through that adjustment, that will weigh on productivity growth. Once you come out the other side, things will be better, but there is a period of adjustment. And then the third, so those two things are weighing on potential output growth, particularly in the near term. The third factor, which what you mentioned, is AI. And there's no doubt that AI is a transformative technology, and as it gets adopted by more and more businesses, and as they use it in their businesses, we do expect to see a labor productivity growth pick up. And so that we have built in a modest increase from AI in productivity growth going forward. It builds over time. I think on average, it's adding about 0.2 to productivity growth in the projection. So taking those three things together, potential output growth is fairly weak in the near term. But as the restructuring advances and as the effects of AI accumulate, productivity growth picks up going forward. So that's built into our projection. Is AI having a big effect on our policy decision right now? No, but it is built into our projection, and it could end up that AI comes faster, has a bigger effect than we've expected. It might take longer. We'll see. That's something we'll be assessing going forward.
Go ahead, Mark.
Thanks for taking the question, Governor. So you spell out two kind of major risks. One is oil prices remain elevated and you're forced to raise interest rates. The other is the CUSMA talks take a turn for the worse and you are forced to cut. Those aren't mutually exclusive risks. What happens if we end up in a scenario where tariffs have risen, CUSMA talks have floundered, and oil prices remain high? How do you balance those risks?
Look, I provided a couple of examples, and I think the reason I provided those two examples is, those are very salient assumptions in our projection, around which, frankly, there is a lot of uncertainty, and it's not the regular kind of regular economic uncertainty. These are geopolitical events, so it's hard to assess probabilities as to exactly what's going to happen. And yes, as we outlined, the message really is that, look, today the best decision is to maintain, but monetary policy, the situation could change. Monetary policy may need to be nimble, and we provided a couple of examples. If there's significant new trade restrictions on Canada, that could have a material impact on the Canadian economy. We may need to cut to support growth. If oil prices go up, and particularly if they stay up, the risk that inflation becomes more persistent goes up, and there may need to be increases in the policy rate. And as we indicated, probably more than one, consecutive increases. Those are not the only things that could happen. To give you another example, financial markets have been very resilient through this. We could see an abrupt repricing in financial markets. That would be, another kind of shock that we would need to take into account. And as you indicated, the reality is more than one thing. There's many combinations of these things that could happen. In laying out those two examples, and in particular in showing the alternative case in the NPR with a permanently higher oil price, what we're trying to convey is, sort of the direction and the rough magnitude of how we would respond given given some different possible situations. Obviously, if it's a combination, it's going to be even more complicated, and we'll have to weigh various factors. The point of sort of laying out these alternatives is really to give a sense of how we would likely react in certain situations.
All right, next on my list, I have the Canadian Press, followed by CTV, then Market News. So go ahead, Craig.
Thank you, Craig Lord with the Canadian Press. Mark stole my question. I can figure out another one. With the suggestion that you are prepared to potentially take consecutive increases to the policy rate if we see elevated and sustained global oil prices, what is the time frame that Canadians should be expecting you to be looking at these global oil prices? If we are at the end of the summer and we haven't seen much change in the global price of oil, should Canadians then be expecting interest rate hikes coming down the pipeline?
Look, obviously, the higher oil prices go, and the longer they're higher, the more likely it is that we'll have to raise rates to bring inflation back to target. But I want to stress, there is no set timeline here. It really depends on the conditions. It's going to depend, importantly, on what oil prices do, what we think they're going to do going forward. It's all going to depend on what we see. How much are higher oil prices spilling into the prices of other goods and services? How much is our outlook for inflation changing? I mean, is that substantially increasing the persistence of inflation? So it's going to depend on those conditions. So, I mean, what I would stress is it's about the shock itself, and it's about the propagation of the shock. And, if if we're in a situation where the shock's bigger, and in particular, it's more persistent, and we see clear evidence, we see growing evidence of propagation, that would be a clear signal that, yes, rates probably do need to go higher to get inflation back to target.
Sorry, go ahead, Paul. Oh, sorry, Annie. Sorry.
Sort of a similar question to one of my colleagues, but you're talking about the potential impact of U.S. tariffs, but also of higher oil prices. And the Monetary Policy Report does outline what the situation could look like if oil remains at $100 a barrel. I'm wondering, what does the bank see as more of a pressing threat to the economy? Is it U.S. trade policy, potential U.S. tariffs being added, or oil prices being elevated and remaining closer to that $100 a barrel that you talk about in the Monetary Policy Report?
I think I'd come back to thinking about it in terms of time. So in the near term, the shock that's sort of hitting us most directly is the war in the Middle East. It's pushing oil up, and that's having an immediate impact on near-term inflation. And as the governor said, if that persists, that's going to that the risk increases that oil price starts to feed into the price of other things, and we need to deal with the inflation shock. Over the longer term, the trade tensions are the bigger threat to the Canadian economy, and there, we've got a restructuring underway, but we also have a review of the trade agreement that we're expecting to happen this summer. If there is a big change in that agreement, that could also present sort of a new shock to the economy too. So, sort of think about it in terms of two time frames.
Go ahead, Greg.
Greg Quinn, Market News. I wondered if having the policy right now at the lower end of the so-called neutral range makes you a little more nervous about the potential need to tighten, and is this in another way why you're talking about a potential set of consecutive hikes?
Well, look, I would emphasize that there was a clear consensus on the Governing Council that the best thing to do today is maintain the policy interest rate where it is. But I will stress that there is no risk-free path for the policy interest rate. If we had raised rates now, and then oil prices come down in line with what the market's expecting, by the time those higher interest rates are impacting the economy, they wouldn't be needed, and we'd wished we hadn't raised the policy interest rate. But look, if oil prices stay high and we hold rates we maintain for too long, we could see higher energy prices spread to other prices of other goods and services and start to become more persistent inflation. In that case, we'll probably wish that we'd raised rates earlier. So we've got to manage both those risks, Greg. And as I said, I think there was a clear consensus that right now the best thing to do is maintain. But let me add two additional points of context. First of all, the current context is we're starting from a situation where inflation has been close to target for roughly a year and a half now. We're also starting in an economy where there's some slack. You can see it in the labor market. Our estimate of the output gap is it's around minus 1%. So we're starting with some slack. So in that context, we don't think higher energy prices are going to be rapidly passed through to the prices of other goods and services, because when there's some slack in the economy, when the labor market is soft, businesses they're cautious about passing on price increases. They're worried about losing clients. So we don't expect it'll be rapid. I think you're clearly going to see it in some places. You're already seeing fuel surcharges in some places, but we're not expecting it to rapidly broaden. But that's something that needs close monitoring. The other thing I would stress is that we know uncertainty is high. And we recognize that monetary policy may need to be nimble. If the situation changes, we may need to change course. And as I've said a couple of times, if if oil prices go higher, and particularly if they stay higher for longer, that will increase the risk that inflation generalizes and becomes more persistent. And in that case, yes, we may well need consecutive increases in the policy rate to get inflation back to the 2% target.
All right. The next question will be from Bloomberg, followed by the Wall Street Journal, and then Global News. So go ahead, Najud.
Good morning, Governor. Cora is still stuck higher than the bank's target. You've given no indication you plan to fix any dislocation issues there. Is that still the case?
Sorry, can you just say the last part again? Core is above the target.
Yes. You've given no indication that you plan to fix any dislocation there. I'm just wondering if that's still the case.
Well, I mean, on core, I mean, just to take you back a bit, as you'll remember, total CPI inflation came down.
I'm asking a Cora.
Yeah, I know. I'm getting to
Oh,
core.
sorry.
Our target is total, Najud.
So
Don't
Cora,
forget.
I think she said.
Oh, Cora.
Yeah.
Oh,
yeah,
sorry.
So
Okay. Cora, so you were talking about the fact that from time to time we need to do overnight operations.
yeah, I mean, we've got a little bit of a margin, Jude, but we have some tolerance there. So I mean, you've called it a dislocation. I guess that's maybe a stronger term than what we would choose. So I mean, our market operations are basically back to sort of normal course. Our balance sheet's back to being normalized. So we keep an eye on Cora, but I guess we wouldn't characterize it as a dislocation.
Sorry about that. Cora,
Okay, Paul.
Governor, I wanted to maybe go back to previous questions, but what I want to know is what motivated you and the Governing Council to provide this form of forward guidance today about, when rates may increase or when rates may decrease.
Well, Paul, I wouldn't really characterize this so much as forward guidance, and it's not about when something's going to happen. It's about it's really more about our reaction function. It's about what, the Governing Council is very aware that there are a wide range of outcomes that are possible. And as part of our deliberations, we not only discussed what the best thing to do today is, but we also discussed what would we do if some of these other outcomes were to materialize. Because you got to recognize that when you're taking there's a lot of uncertainty, and yes, we have a baseline outcome, but we're the first ones to admit that is not the only possible thing that could happen, and there is an unusually wide range of things that could happen. So as you discuss about what the best thing to do today is, you need to also be thinking about what, how well positioned are you to deal with these other things. So that's why we discussed those, and having discussed those, I think it is useful to convey, certainly directionally, how we would handle these various outcomes. I think we're not the only ones grappling with this uncertainty. Everybody's trying to grapple with uncertainty. Our job is to be a source of stability, a source of predictability. So what we're saying is that, we're prepared to respond as needed, and, we're giving some broad strokes as to what that could look like.
All right, Mac.
Mackenzie Gray with Global News. Talk about consecutive rate cuts probably gives you, and I'm sure some Canadians who might be watching, some nasty flashbacks to where we were with COVID. What lessons have you learned from that spike, and what do you plan to do differently this time to avoid a similar inflation run-up?
Well, maybe we could both take that one, since I think there's more than one lesson from COVID. Look, I think one of the key lessons from COVID is, as we were coming out of COVID, there was certainly a combination of shocks, very disrupted global supply chains that persisted for some time. Obviously, Russia's unprovoked attack of Ukraine really boosted food and energy prices. And the impact on inflation was large and it was rapid. And I think one of the lessons from COVID is that when the economy's already overheated, when it's already in excess demand, an additional, a big negative supply shock that boosts global energy and food prices can spread quickly to other goods and services. And it gets back a bit to my answer to Greg. It's the flip side of it. When the economy is already in excess demand, companies are having trouble actually keeping up with all the demand for their goods and services. So when their costs go up, they're like, well, we might as well just pass this right on. We're having trouble keeping up already. Let's just pass these price increases on. And that's what we saw in COVID. Not only were companies increasing prices by more, they were increasing prices more frequently. And to be frank, as a result, our models were having trouble keeping up with how fast inflation was going up. Today's situation is quite different. The economy is in excess supply. And as I said to Greg, against that background, businesses are a bit more cautious about passing on cost increases. Doesn't mean they won't pass them on at all. And certainly in businesses where energy is a big part of the cost structure, they have to pass some of it on. But they will tend to be more cautious. I don't know if you want to supplement that.
Well, Mark stole your question and Governor stole my answer, but maybe what I'd add is, you're right. When we're always our current thinking is always affected by what happened in the past, and it is true. Big consecutive increases in the interest rate. We know that's a pressure on Canadians, but what we also learned really clearly is they don't like inflation either. Canadians don't like inflation either. So we would raise interest rates with the sole purpose of making sure we keep inflation at target. So, yeah.
All right, we'll go to the call now. I just want to remind people on the call to mute their line if they're not asking a question. So we'll go to Rob McLister.
Good morning, Rob McLister from MortgageLogic.news. You've mentioned it's especially vital to watch medium and longer term inflation expectations. So many Canadians are wondering what de-anchored expectations look like. So in the latest Business Outlook survey showed medium term or 2-year expectations at 3.4%, rising 60 basis points in a month. If the next 2-year expectations reading gets closer to 4%, would you still consider that to be anchored inflation expectations?
I think maybe what I would say, Rob, is when we look at inflation expectations, what we know about consumer inflation expectations, it's a bit different than business expectations. They're very affected by the current perception of inflation. And current perception of inflation is really very affected by the things you buy most often, everyday groceries and gas. And we know that the shocks we're seeing right now are pushing gas up, and groceries, food inflation has been a bit higher than headline inflation. So we keep that in mind when we look at how consumers view inflation expectations. More in general, what I would say is you need to be careful to look for trends versus month over month impacts on inflation expectations. So, we keep a very close eye. We look a little bit differently at how businesses see inflation expectations versus consumers. But what we're really looking for is an overall trend line. Is there a break point? What you're asking for, is there a number at which we completely change our view? No. We combine what we're seeing in that data with other things and other feedback we're getting and outreach and stuff. So there isn't sort of a number at which we turn from one view to another.
I just add, Rob, just to broaden this a little bit. I think one thing we're conscious of is that coming out of COVID, inflation rose rapidly to just over 8%. And for many Canadians, this was really the first material inflation they had experienced in their lifetime. and unfortunately, a whole new generation of Canadians learn just how painful inflation is. And against that background, Canadians may be more attentive, may be more aware of the risks of inflation. And as Carolyn just mentioned, particularly when it's in food and gasoline, things people tend to buy every week, it can have a very immediate effect on their inflation expectations. So, there is a risk that inflation expectations aren't as well anchored as they were, before COVID. On the other hand, we demonstrated inflation went up just over 8%. We also brought it back down to 2% relatively quickly. I won't say it was without pain. It certainly was not easy for many Canadians, but we didn't cause a recession. We got it back without a recession. And what we saw in our own public trust, surveys of public trust in the Bank of Canada, when inflation went up to 8%, Canadians were quite rightly asking a lot of questions. Public trust in the Bank of Canada went down, but when inflation came back down and has remained at 2%, that public trust has come back down. So it on that basis, it doesn't look like the credibility of the central bank and our resolve to keep inflation close to Canadians' confidence in price stability has been eroded. So, these are more psychological factors, but as we assess what's happening with inflation expectations, we are alive that, we are cognizant of the fact that how people form their expectations may evolve over time. And that's something we'll certainly watching closely.
All right, that was the last question, and so that will conclude today's press conference. Thank you to the Governor, Senior Deputy Governor, for taking the questions, and to all of you for joining us. Merci.
Thank you.